John Higgins, Mortgage One. Happy Monday. So we've made it through another Fed meeting and a lot of fireworks around this one, obviously, with the Silicon Valley Bank and the Signature Bank meltdown and failure. We've seen interest rates kind of roll back a bit off that. So we know the Fed raised rates 25 basis points. That was off the worst case scenario that we saw maybe 2-3 weeks ago before all the bank issues came up. There was talk about a zero move on the Fed, but in the end, I think the Fed is still looking at inflation and thinking they're not quite ahead of it as far as they need to be. Although, the prognosticators out there as far as interest rates think that we are coming to the end of all these Fed increases. In fact, the next Fed meeting is May, and the bet is in that that will be the last 25 basis point rise. So what does that mean for our real estate industry and mortgage rates? So we're heading into the spring selling season, and rates are, in pretty decent shape. The 10-year Treasury, after, hitting a high of 4.25% earlier this year, we're back down below 350 on that 10-year Treasury, and that's making a big difference in our mortgage rates. So we've seen a nice rollback where we were threatening to go well above 7% earlier this year. Now we're starting to lower down towards 6. We're probably sitting somewhere in the 6.5% range today. So all in all, a pretty good meeting. The bank issue, really what it's causing is a tightening potentially of credit for commercial loans and that. Not so much on the real estate side. And that will help the Fed cool the economy. So all good things coming out of that. It's never good to see a bank fail and the contagion that could come of it. But, as we head into this spring selling season, certainly in much better shape than we were 30 days ago. So if you have any questions, give me a call and have a great week.